In this video, I wanted to go into more detail in how Fed policy will define the boom-bust cycle. And for this, we need to understand what money actually is. So what is the natural hierarchy of money? Money, there are different kinds of money. And the true money is gold. This is the highest quality of money. And there's only a tiny bit of that in this world. But this is the highest quality of money. Gold is money. Okay. Below that, we have currencies. They are promises to pay gold. And below currencies, we have deposits on the banks that are promises to pay currency. And below deposits, we have securities like stocks and bonds, treasuries, which are promises to pay you deposits, promises to pay you your cash, and the cash is a promise to pay you the real money, which is gold. So you have this pyramid, and this pyramid widens when you go to the securities. There are countless amounts of derivatives. So this is very wide, and this can get wider. And that happens when you have a boom. If the economy booms, that means that this pyramid becomes wider and liquidity will move from gold into these securities and these derivatives, stocks and bonds. When credit contracts, we will have a credit bust, and then this widening pyramid will narrow again. And that's when liquidity moves from stocks and securities back into cash and ultimately into gold. So very important to understand this pyramid and how it widens and narrows again. Okay? And how money flows from here back to here in a bust, and in a boom it flows from here to here. Okay? Now over to Fed policy. So this is a chart with the interest rate on the y-axis and maturity on the x-axis. So this is just a yield curve, right? And a normal yield curve has a policy rate that's low, and this is the Fed policy rate, and we have a market rate that's higher. So this is the, for example, the 30-year bond yield, which is currently at 4% probably, and policy rate is higher. But okay, so this is the yield curve, and when you have a lower policy rate and a higher market rate, then you have an elastic yield curve. So this is a normal yield curve. Sometimes the Fed will hike rates, so the policy rate moves up, and then you get an inverted yield curve. So the term structure is now inverted, and that's scarcity. So this is an inverted yield curve. That's what we have right now. We have the Fed funds rate at 5%, and the market rate is only at 3 to 4%. So the Fed is now inducing scarcity in the system. So what does this mean? If the policy rate is higher than the market rate, then you are actually moving money from credit, this is credit, you're moving it back to currency, right? Because here you get a higher interest rate. So you are moving stocks and bonds back into currency and gold, of course. That's a credit contraction. So if you have an inverted yield curve, you are inducing a credit contraction. If this moves back to elasticity, then you are expanding again. Then you are expanding, you're booming again, and money will flow from gold and cash back into stocks and bonds and loans. So as the inverted yield curve moves back into an uninverted yield curve, then you will have a boom again. So that's how you look at it, going from scarce to elastic, going from boom to bust. Okay, that's how money flows. Now we are going to look at this empirically. So what is this chart? This is the Fed funds rate. This was the policy rate. That's this rate here. And you see that it goes up and down. And at times when the Fed hikes rates, for example here and here, that's a period where the Fed is hiking rates here as well. What are you doing? Then you're going from elasticity into scarcity. You are creating an inverted yield curve. So here we go inverted, here we go inverted. And what happens when you invert the yield curve? Then you are inducing money from credit into gold and cash. So you're inducing a bust cycle. The pyramid goes narrower and these things go into gold. So what do we see here? Rate hikes will lead to a rising gold price. This is the gold price. Same here, rate hikes lead to eventually a higher gold price. Same here, higher gold price. So that's what is happening behind the screens. You are inducing a credit bust where money flows into quality, gold. At some point, yeah, and you can also see that here, stocks are falling at the same time. That's because stocks, liquidity from the stocks are moving into gold, right? As the Fed tightens the screws. Now, at some point, the Fed is done, doesn't want to keep hiking rates because they see that the economy is crashing into a recession. Too much money is going back into gold. That's not good. So they are going to stop hiking. So at some point, they know that they have been tightening too much. So a credit bust is starting to happen. So they stop hiking. So from here on out, they cut rates again. So from scarcity, they go back to elasticity. And here we are going from bust back into boom. So that's where money flows from gold back into stocks and bonds and loans. And that's what's happening here. So the Fed starts to uninvert the yield curve. So here we have an uninversion where we go from scarcity to elasticity to a normal yield curve. And when they do that, and there's some delay on that, then stocks will start to move up again. So there is a delay, right? So here it's probably back into a good yield curve, uninverted. Stocks go up and gold is not that strong. Same here. Stocks go up and gold is not performing. Same here. Stocks go up and gold is not performing. Okay, so this is actually the credit expansion phase. Here it is the credit contraction phase. Contraction, expansion. Okay, so that's how you need to look at it from a credit boom and bust cycle. Now, how do we play this? When do we buy gold and when do we buy stocks? Well, you need to look at the inverted yield curve. So these points are typically inverted periods. So that means that you have scarcity. The Fed wants to induce a credit bust at these points because they think the economy is overheating. This is the same as here. These are the inverted yield curves. All of these points here are inverted yield curves. So whenever you see this happening, this inversion, you need to buy gold. Okay, so here we always see that gold goes up when we have an inverted yield curve. And why is that? That's because, as you can see here, the Fed has been tightening. And as they tighten, at some point, it will spill over into gold and gold will go up. As you can see here, tightening is a bust and that money will go into quality money, gold. So this is how you play this. Whenever you see the inverted yield curve, buy gold. And as this uninverts, so when we go to the other side, to the top, then you will have an uninverted yield curve, an elastic yield curve. And that's when the credit boom will start. So here, the credit boom will start. Here it will start. Here, credit boom. And that's when you buy stocks. You don't buy stocks here at the inverted yield curves. You buy stocks when you are at the other side. When the Fed actually goes back to elasticity and wants to increase the credit in the system. That's somewhere here, 2010 and 2003 to 4. When you look here, 2010, yeah, that's the other side. 2003, 4, that's here, the other side. Here you buy stocks. Here you buy stocks. Okay? Do not buy stocks here and here because that's when the Fed is actually tightening the screws. Stocks will underperform. Stocks will underperform because that money is going into gold. So where are we currently? Currently, we are here. Massively inverted yield curve. Very scarcity, a lot of scarcity. Policy rate is going to keep on rising because they are going to hike interest rates some more. Hike 2 times maybe this year. So this is going to keep on inverting. That means that we're still in a bust cycle. And in a bust cycle, this pyramid becomes narrower and the lower quality derivatives will spill over into gold and cash. So that's how you need to look at it. And once this inverted yield curve uninverts again, when it goes back up, and the Fed lowers their policy rate, that's when you go into stocks. When this thing here goes back positive, then you sell your gold here and buy stocks. Here, you need to be in gold. So this is extremely important to understand where you are in the cycle, because it's life and death for your portfolio. You need to understand this. Otherwise, you will have no sight on what is happening. So please understand this, and I'll see you in the next video.